Namaste, good morning. We are starting with the revision of investment accounting. We are starting with investment accounting. Okay, and the base is Accounting Standard 13, which gives us the fundamentals of investment accounting, how to account for, etc., is mentioned in this standard. Okay, right? Basically, investments are classified into current investment, and the other term is non-current, but I am writing the more clear term, long-term investment. Okay, basically investments are classified into on the basis of your intention of holding. On the basis of your intention of holding, whether you want to hold it for a period less than 1 year or keep rotating it, we call it as current investment. If you have the intention of holding it for a longer period, then we call it as non-current or long-term investments. Basically, okay, the practical aspect of this chapter more speaks about current investment and its accounting, whereas long-term investment is spoken theoretically in this particular standard. Okay, okay. Current investments are held for trading on a regular basis or for a short-term period, whereas non-current is held more as an permanent asset. Okay, non-current investments are held as more as permanent. Okay, the focus of this chapter is to specify how to account and value current investments, how to value non-current investment, for balance sheet purposes. Okay, right? Let us not worry now about non-current investment. Let us walk into current investments. Let us walk into current investments. This is further classified into my dear friends, this is further classified into, okay, fixed return bearing investments, variable or flexible return bearing investments. Okay, fixed return bearing investment, flexible return bearing investment. Fixed return means two things, that is, the quantum is also fixed and there is a certainty of its result. The quantum is also fixed and there is a certainty of its result. Flexible return bearing investment, the quantum is also not certain and it is not sure whether they will whether they will get the return from the organization or not. Okay, as we go more detail, we will look into it. Okay, fixed return bearing investments. Okay, fixed return bearing investments. Okay, debentures is actually investment in debentures, bonds, government securities, loans are covered in this. Okay, So these are okay. What is fixed bearing investments? What is fixed bearing investment? The return is also constant and the return is certain irrespective of the performance of the organization. Okay, two things qualify to be fixed return bearing investments. Two criteria. One, return is also sure. You will not miss the return. Irrespective of the company's performance, the return is sure. And the return is just because the company is earning too much of profit, you will not get too much of return. Okay, and vice versa. Just because the company is making loss, it is not that your return is under stake. The risk is lesser. The risk is lesser. So the return is also constant and the return is irrespective of the performance of the organization. Bigger performance doesn't envisage you to get higher returns. Lesser performance does not mean that you will not get the required return. Okay, so return is constant and that is what is known as fixed return bearing investment. We talk about investment in debentures, bonds, government securities, loans. All these things are covered here. Okay, according to AS 13, there are two bases of valuing, okay, fixed return bearing investments. There are two bases of valuing fixed return bearing investment, FIFO or average cost method. Okay, in this my dear friends, FIFO is more preferable. Okay, there are two bases. You can either value it on FIFO or on average cost basis, but what is more preferable is FIFO basis is more preferable than average cost basis. FIFO is more preferable than average cost basis. Okay, from the academic, from the examination perspective. Okay, if the question is silent, then FIFO will be the basis. This is purely from the examination perspective. This is from the, if the question is saying, do it in FIFO, or if the question is silent, do it in FIFO. Only if the question specifically tells, do it on average cost basis, you should do it on average cost. Otherwise, it will be only FIFO. Okay, repeating, if the question is silent, do it in FIFO. If the question says FIFO, please go ahead. If the question specifically states that do it on average cost, then only you need to do it on average cost basis. They will give in examination. Suppose if the question is silent, don't get confused. You should go ahead and do FIFO because FIFO is the most preferable option. FIFO is the most preferable option. Okay, right, my dear friends, let us move on to accounting for fixed return bearing investments. Accounting for fixed return bearing investments. Okay, right, accounting. Okay, right, there are three columns. Okay, I hope you remember the columns are face value, which will be unless otherwise stated rupees 100. Okay, okay, face value, my dear friends, is always 100. If the question says 10, I don't think they'll say. But if the question says 10, you 10 or 50 something else you are. Otherwise, face value will be rupees 100 for fixed return bearing investment. Comma, interest, okay, which should be accounted on accrual basis always, and cost. There will be three columns, my dear friends. There will be three columns: face value, interest, cost. Okay, in terms of accounting, in each side, when I say each side, I mean debit and credit side, there will be three columns. Face, apart from date and particulars, I'm talking, apart from date and particulars, there will be three main columns: face value, interest, and cost. Face value, please take it as 100 if the question is silent. Okay, interest always accounted for accrual basis, and cost will be the price paid. Okay, right. Whenever investments are purchased, it can be either X interest or cum interest. Okay, whenever I'm sorry, whenever investments are purchased slash sold, you can even understand it. Whenever investments are transacted, it can be either X interest or cum interest. Whenever there is a transaction in investment, it can be either X interest or cum interest. Okay, X interest means exclusive of interest. X interest means we all know it is exclusive of interest. In other words, the purchaser is liable to pay, apart from the cost, the interest portion accrued till the date of transaction. Okay, X interest means exclusive of interest. 1,000 debentures are purchased 103 X interest. The purchaser. When I buy, I am the purchaser. When I sell, the other person is the purchaser. The purchaser is liable to pay, apart from this 103, the interest till the date of transaction. The interest till the date of transaction. Repeating, X interest means exclusive of interest. The purchaser, I may be the purchaser when I am purchasing. When I am selling, the person to whom I am selling is the purchaser, is liable to pay. Either I have to pay or I have to receive. Is liable to pay, apart from whatever has been quoted. In our given example, I told you 1,000 debentures of rupees 103. Apart from this 103, the interest till the date of the transaction should be paid. Should be paid. That is known as X interest. So transaction value will be cost plus interest. Repeating, transaction value will be, transaction value means the money outflow will be cost plus interest. Okay, cum interest means cumulative of interest. In other words, the transaction value includes interest. While recording, interest needs to be deducted for arriving at cost. Okay, right friends? So, what is the next one? It is nothing but, okay, cum interest means cumulative of interest. If I say 1,000 debentures of rupees 103 cum interest, that means the transaction value includes interest. 103 includes, or 103 becomes the transaction value to find out the, because I will not get more than 103 when I sell it, or when I purchase, I will not give more than 103. But when I record it, that 103 has an interest component. So I need to segregate the interest component and record the interest component in the interest column and cost component in the cost column. So repeating, cum interest means cumulative of interest. The transaction value includes the interest. Here transaction value is equal to cost plus interest. Here transaction value is what is given. Cost is equal to transaction value minus interest. Minus interest. Okay. I hope these things the class remembers. In our classroom, we have elaborately, in our regular classrooms, we have elaborately discussed these things. Okay. So and there is an exercise also in all the chapters. In front, I am giving you an exercise. For all those things, I will give it to you the answer in one shot. Okay. So that I thought I will give you some time to fill up that exercise even after the chapter is over, so that you are very clear about everything. Okay. Cum interest means cumulative of interest. In other words, the transaction value, it includes interest. While recording, interest needs to be deducted for arriving at the cost. Okay. Then when investments are sold, profit or loss on sale needs to be identified and recorded. Friends, when investments are sold, the profit or loss, repeating, when investments are sold, the profit or loss needs to be identified for every sale transaction. I need to identify it and recorded for every sale transaction. I need to identify and record it. Okay, and this is where this concept of FIFO or weighted average becomes more interesting. If it is FIFO method, I ensure that the first investments I purchased or sold, if it is weighted, if it is average cost, I should take the average of so far purchased. Okay, but please be very clear. If the question is silent, follow only FIFO. FIFO is the most recognized method. Okay, investments at the end of the year will be valued either at cost or market price, whichever is less. You can even use the term net realizable value. Investment at the end of the year will be valued at cost or market price, which can also be net realizable value, whichever is less. So if, okay, and we all know, if investments are valued at market price, nothing but NRV, net realizable value, my dear, then the loss of valuation should also be recorded. Then the loss of valuation should also be recorded. Okay, then the loss of valuation should also be recorded. Please read through it once. Okay. Okay. So friends, the accounting for fixed return bearing investments. Okay. Let us virtually see date and particulars, face value, interest cost or the columns in both sides, debit and credit side. Normally this will commence with the opening balance. Normally this will commence with the opening balance. Okay. And the interest accrued till the date of opening balance should be recorded in the interest column. The interest accrued till the date of opening will be accrued in the opening column. Okay, so it will normally commence with the opening balance or okay, with it's an asset. So opening balance on the debit side. We all know it's an asset with the opening balance is on the debit side. The interest accrued till the opening should be recorded in the interest column because last year they would have accounted it on accrual basis and closed it, and the cost will be very clearly given. Then comes the transaction. Look for information on two things. Is it an X interest transaction, cum interest transaction? If the transaction is silent, always X interest. Which in other words, what I'm trying to say is, if it is cum interest, they will say cum interest. If it is X interest, either they will say X interest or remain silent, which is also meaning that it is a X interest transaction. X interest means apart from the price which they have set, also pay interest. So when I purchase, it will be to bank. Whatever price they have set will go to the cost column and the interest till that date will come to the interest column. When I sell by bank, whatever is the price they have set will go to the cost column. The interest till that date will come to the interest column. If it is cum interest, then comes the issue of because what is stated is along with interest. So it will not directly go to the cost column. From that value, reduce interest till the date of transaction and record it in the cost column. Put the interest or record the interest in the interest column. Similarly for purchase and sale. Friends, if the purchase or sale is happening on the date of transaction or on the immediate next day, just don't worry about interest. In X interest or cum interest doesn't matter. If the transaction is happening on the date of interest or on the subsequent date, don't worry about interest. Further, every 6 months the interest will accrue or interest will be paid. Ensure to record the interest on the credit side. It's an income. Okay. Keep crediting, then we will transfer it to P&L. Every time there is a sale, record the profit or loss on sale. And year-end valuation should be at cost or market price, net realizable value, whichever is less. If you are valuing it at net realizable value, which means it is lesser than cost, record the loss also. With this, we enter and do some solutions. So up to page number 3 is something which you can rapidly fill it up. Okay, you can take your time. I will give you the answers for those things also in one shot. For all the chapters put together, I'll give it to you in one shot. I'm in question number 1 in page number 4. Question number 1, page number 4. The material is either there in the group or in the Teams ID. Okay. The following information is presented by Mr. Z relating to his 9% government bonds. Opening balance, the cost. Purchased the 200 units on 1st March, X interest 98. 17 sold 500 units ex interest out of original holding rupees 100. 110 purchased 150 units 98 come interest. 111 sold 300 units ex interest 99 out of original holding. Interest dates are 30th September and 31st March. Mr. Z closes his books on 31st December. Show the investment account as it would appear in his books. Mr. Z follows FIFO method. So as I told you, FIFO means they will either say, if suppose the last line is not there, then also I will follow FIFO only. Only if they specifically say average cost, I will follow average cost. Please have this call. Draw neat lines. These things are examination, will not take time, at the same time scoring arena. Scoring arena. Opening balance, which means they are closing on December, which means 1/1/2018. 1/1/2018. The face value, okay, is balance brought down. Okay, I will write it as for ease of purpose 2018, so that I need not again keep writing the year. Okay, 1/1 balance brought down, 1/1 balance brought down in the face value 1,20,000. In the cost column 1,18,000. And what is the interest accrued? The interest is paid in the month of 30th September and 31st March. Last time they would have paid interest is 30th September 2017. Last time they would have paid interest is 30th September 2017. So the interest accrued will be 2 lakh, I mean 1,20,000 into 9% into October, November, December, 3 by 12. Okay, 2,700. Anybody not understanding, please unmute and ask me the doubt. The interest outstanding will be face value into rate of interest into accrued months. Okay, in the theory, probably if you have not left a line, please add it somewhere and keep it. This is important. In exam also note me. Okay, interest will always be computed on face value. Okay, I know it's a very small or silly note, but that is essential. Examination tension level, we should not forget it. That's why I am writing it. Okay, so 2,700. Are you following? Are you following Ramji? Are you following Ramji?
Yes, sir.
Yeah. So because I'm not doing a working note, now I am saving time for our, okay, in the examination also for important things do working note. For these things, if you want, quickly write a working note saying for 3 months. Otherwise, it's understandable. Don't worry. On 1/3/2018, purchased the 200 units X interest. On 1/3, okay, bank. How many units purchased? 200 units into 100 is the face value. The purchase is X interest. So whatever has been mentioned is the cost. The purchase is X interest. So directly into the number of units, you will write it in the cost, and in the interest column it becomes simple. Always interest is computed on face value into number of into percentage into accrued till the date of transaction. So it will be 5/12. It will be 5/12. Anybody not understanding, unmute and ask me. I hope the class is following. Okay, right? 1/1. Okay, I mean 1/3. The transaction is on 1st March. I purchased 293 98 X interest. So X interest transaction, you put directly 200 into 98 in the cost column. And yeah, this will be 200 into 100. Accrued will be, we have already seen in the theory, okay, whether it is, in other words, the purchaser is liable to pay apart from the cost the interest accrued till the date of transaction. Transaction is 1st March. Last time they would have paid interest on 30th September, October, November, December, Jan, Feb. 5-month interest accrued. So I would have paid to my to my seller 19,600 plus 750, 20,350. The next transaction is directly interest transaction. Okay, 2018 here also 31/3. 31/3 bank. Okay, how much is the interest? When whatever debentures I have on that date, for that 6 months interest I will get. Okay, interest will be whatever debentures, the face value of debentures I have on that date into 9% into 6 divided by 12. Okay, whatever is the face value of debentures I have on that date into 9% into 6/12 will be my interest. Will be my interest. I hope the class is following.
Sir,
Raja?
why we are calculating for the 1/3 transaction also, sir? Because it was purchased on 1st March only, sir.
So
Why we are
you
calculating
should
6
get the
months?
interest for.
Only 1 month now, sir.
So if I
According,
credit for 6 months and debit for 5 months, the net is,
sir, I can't.
if I credit for 6 months
Okay, sir.
and debit for 5 months, you
1 month will be
see I have debited for 5 months.
5 months.
Okay, I am crediting it for 6 months. So the net effect is
1 month.
correct?
Yes, sir. Okay.
Yeah, that's why we are doing like that. Okay, after all, accounts is to do with,
Credits and debits.
that's all. Okay, so the next transaction is also after the subsequent interest date. So 39 also the same interest will come. Okay, right? 1,20,000. Sorry, 1 lakh
So there's
20.
an another entry in
Sale,
first June.
I'm missing out. Oh, 17. Sorry. Yeah. Thanks for correcting me. 17 sold 500 units X interest out of original holding. Sorry, friends. This is not okay. This is 17 bank. How many units are sold? 500 units are sold. 500 into 100 and it is sold for 100. X interest. The wordings is X interest. So directly I can put 500 into sale price of 100 and the interest accrued will be face value into rate of interest into last time they paid on 31st March, April, May, June, 3 by 12 and the interest accrued will be 1125. How I got this? Face value into rate into 3 by 12 into 3 by 12. I got the interest. Any doubt in this? Any doubt in this? Okay. Leaving some 5-6 lines. Leaving some 5-6 lines. Okay, leaving some 5-6 lines, my dear friends. Two more transaction, 4, 5, 6 or 7 lines, more than enough. Working note for sale on 17. Working note for sale on 17. Sale value of 500 debentures. We all know that the sale value is 50,000. FIFO is the method of valuation. So in the opening, I had 1,200 debentures. In the opening, I had 1,200 debentures for 1,18,000. Out of this, 500 is sold. Out of this, 500 is sold. Less cost on FIFO basis. Okay. So I am working out the cost. Please check whether you are understanding. 1,18,000 divided by 1,200 into 500. 1,18,000 divided by this 1,18,000 is for 1,200 debentures. What is for 500? What is for 500 that is sold? Therefore, I get a profit. Okay. Therefore, I get a profit of 833. Therefore, I get a profit of 833. My dear friends, I hope the class is understanding how I am working it out. Okay, I took 1 lakh, I took the sale consideration. Okay, I took the sale consideration and also identified the cost on FIFO basis. 17 P&L account. Okay, nothing but 833. 833. I hope we are following. Okay. The next transaction happens only after the next interest date. So 39 bank, the interest will be, please understand, is equal to 1,20,000 plus 20 minus 50. This is the amount I have into 9% into 6 by 12. Repeating, interest will be the face value of investments I hold on that date. The face value of investments I hold on that date. The face value of investments I hold on that date into rate into 6 by 12. Okay, right. The next transaction interestingly happens on the next day. So interest column, whether it is come interest or ex interest, does not make any difference at all. Okay, it is because there is no interest accrued. 110 bank, how many units are purchased? 150 units, 98 come interest. 150 into 100 face value and 150 into 98 in the interest column, because whether it is come interest or ex interest, there is no interest accrued. Till yesterday, all the interest are paid. Where is the question of interest accruing? 111. Sold 300 units, ex interest 99 out of the holding. Okay. 111. Bank. I sold 300 units. I sold 300 units, so 30,000. Okay, 99 x interest, so becomes easier. Directly I can put 99 here. And in my interest column, 30,000 into 9% into last time you can see it is paid in September, October, only 1 month it has accrued. Repeating, I have paid till September. The transaction happens on 1st of November, so only 1 month interest has accrued. That is 225. 225, and the principle I have told you is whenever there is a sale, you have to immediately go for computation of profit or loss. Okay, you will do it on a chronological. For your ease of understanding, I am doing like this. 111, working note for sale on 111. Sale value of 300 debentures. Sale value of 300 debentures is equal to 29,700. Cost on FIFO basis will be, okay, 1,18,000 divided by 1,200 into 300, which is sold. So I get a profit of 200. So I get a profit of 200. I hope the class is following. I get a profit of 200. So on 111, okay, okay, profit and loss count is nothing but this 200. All transactions are over. There is nowhere they have given the market price on 31st December. So we have to close it. That's all. Okay. 3112 balance carried forward for face value column. It's every column. It is just that you are going to do that. Okay. And similarly for the cost column. Similarly for the cost column. Similarly for the cost column. Face value and cost column, you will write the balance. Whereas interest column alone, you will compute the interest. 75,000 investments, face value of investment into rate into 3 by 12. Last it is paid in September, October, November, December, 3 by 12. So that here it will be 3112 profit and loss count. Check it out whether you understand. I hope you have completed along with me. I'm going into the second question. Mr. Harish provides the following details of his holding of 10% debentures, face value of X Limited, held as current asset. Opening balance, purchased 98 EX interest. 111 purchased 12,000 debentures at rupees 115 come interest. 31.1 13500 at 110 come interest. 31.3 market value of debentures is 115. Due dates of interest are 30th June and 31st December. Brokerage is to be paid 1% for each transaction. Harish closes his books on 31.3. Show investment account as it would appear assuming FIFO method is followed. Read through the question. I will give you some instructions. Okay. Brokerage will be computed if it is X interest transaction on the cost, if it is come interest transaction on the transaction value. For the purpose, I will again write it as a theory. Even before starting this question, you can write this theory. Okay, brokerage will be computed in the case of X interest on the cost. In the in the case of some interest on the transaction value. Brokerage will be computed in the case of X interest, my dear friends, in the case of X interest on the cost. And in the case of come interest, it will be on the transaction value before reducing interest. Okay, brokerage will be computed in the case of X interest on cost, in the case of come interest on transaction value. On transaction value. At the time of purchase, brokerage, or any other expenses needs to be added to the cost. At the time of purchase, my dear friends, any brokerage or any expenses will be added because I am paying. It will be added. At the time of sales, brokerage or any other expenses will be reduced from the value, from the cost. Okay. So when I am selling also I am paying. When I purchase it is cost. When I sell it is a reduction in my sale value. It is a reduction in my sale value. So I will be reducing it. Read through. I hope it is clear. Brokerage will be computed in the case of X interest on the cost component, in the case of cum interest on the transaction value component. At the time of purchase, it is an cost for you. At the time of sale, it is an expense. So you will reduce it from the sale value. It will be reduced from the sale value. Okay, right? Friends, I'm stopping the presentation. I want you to try the question. I'm stopping the presentation. We will look back the answer in 10 minutes. Your time starts now. Have you completed? Let me know the answer once you complete. For come interest, we should read. Over, friends. Come on, this is revision.
Sir,
Go ahead.
sir, what is that I need to say? The answer right now.
You need to tell me the balance carried down, and you also need to tell me the interest column P&L transfer.
Interest is it 227500 and balance
275.
carried down cost is face value 20 lakh, interest 50,000 and cost 21 lakh 45,640.
Let's wait for our friends to
Yes, sir.
answer.
Yes.
It's the same answer.
Okay.
Sir,
Sir,
cost balance I'm getting 18 lakh 80,000 350, sir.
Illa Raja, let's check. First column should not go wrong.
Okay.
Shall I take you to the answer? And I really appreciate Sai's answer and Viji's answer. It's spot on. It's a good understanding. Friends, friends, this should be your answer. Okay, I'm taking you through the answer. Okay, opening balance 12 lakh 50,000. 12,500 debentures, I believe, and 12 lakh 25,000. Okay. First purchase is on 1st June. I have done the working note for that. Though in the answer I first did without working note. Then I thought it is better for you to. Okay. X interest cost is 9,000 units into 98. 9,000 debentures into 98. For that the brokerage is 8820. Okay, so 890, 820 is the cost, and the interest component is 9 lakh into 10% into 5 by 12. 9 lakh into 10% into 5 by 12. Then comes 36 interest, which is for these two investments, that is approximately 21 lakh 50,000 into 10% into 6 by 12, 6 months. Okay. And then comes the 111 transaction, which is a come interest transaction. 111 transaction, which is come interest. Come interest purchase price is 12,000 units into 115. 12,000 units into 115, my dear friends. Add brokerage, 13 lakh 80,000 into 1%. Add brokerage 13 lakh 80,000 into 1%. Less interest is less interest accrued is, that is 12,000 into 100, 12 lakhs into 10% for 4 months. Last it was paid in June, July, August, September, October, 4 months interest. So it comes for me as 1353800. 1353800. Then comes 31st December interest for all these three things. For all these three things, which is 33,50,000 into 10% into 6 by 12. Then the sale value comes for me like this. Interest sale value 13,500 units into 110. The brokerage for that should be reduced, and the interest accrued for 1 month should be reduced. Therefore, I hit at a cost of 1458,900. 1 month interest, because it is 3112, so 1 month interest on the face value of 13,500. So I get 1458,900. When I take that and work out the cost, how I am working out? For the first 12,500 debentures, I work out the cost directly. And from the second 9,000 purchased, I have sold 1,000. And from the second 9,000 purchased, so 8,90,820 divided by 9,000 into 1,000. So I hit at a profit of 134,920. Then the closing balances, I'm checking the closing balances once. When 20,000 debentures are there with me, that is 2 lakh as the face, 20 lakh as the face value, 20,000 debentures. The cost is 21,45,640. The market price is 115. Cost is less, so I take the cost and then convert the 3 month in, then accrue the 3 month interest. I will get the solution 10. Any question, please ask me. First, I forgot the brokerage and started working the question. That's why I made a lot of things. Now I will give you the correct links so that when you look into the Excel sheet, you are clear. Rajan, you were telling me a different answer in the face value itself. Now did you understand? Adjusted, Raja?
Yes, sir. It was on cost only, sir. So my profit computation was wrong.
Okay. Okay, when you initially see the video, there will be some mistake. I did it without taking the brokerage. I forgot for a minute the brokerage. Then I immediately corrected myself. So please look into the full video. You will understand. Those who are here are not going to look into. For those who are later viewing it. I'm looking into the third question. With this, we'll move on to Raja.
Can you please show me the profit on 31 sir? The calculation only.
This is the calculation, Raja. Okay. A Limited purchased on 1st April 2018 8% convertible debentures in C Limited of the face value of rupees 2 lakhs at rupees 108. On 1st July, A Limited purchased another 1 lakh debentures at 112 come interest. On 1st October, 80,000 debentures were sold 108. On 1st December, C Limited gives the option of converting 8% convertible debentures into equity shares of 10 each. A Limited receive 5,000 equity shares in C Limited in conversion of 25% of their holding. The market price of debentures and equity shares at the year end is 110 and 15 respectively. Interest dates are March and September, whereas A Limited is accounting on calendar year. Prepare investment account of in the books of A Limited on average cost basis. Prepare investment account in A Limited on average cost basis. Quickly read through. So we will do it together. We will do it together. Okay. So that simultaneously, let's not waste time. Okay. So simultaneously, let's do it. In the books of A Limited, 8% convertible debentures of C Limited. In the books of A Limited, 8% convertible debentures of C Limited, and then the columns as usual. I start with the solution. A Limited purchased on 1/4. Okay, so I purchased on 1/4. The interest dates are 31st March and 30th September. So of the transaction is happening on the immediate next day. There is no question of any interest. The interest dates are 31st March and 30th September. So the I don't have an opening balance in this question. This is the first purchase I am making. So there is no question of any interest accrued also. On 1/4, 8% convertible debentures of C Limited of the face value of 2 lakhs at rupees 108. Okay, 1/4. Bank 2 lakhs is the face value, which means 2,000 debentures, because 100 rupees is the, okay, 2,000 into 108. 2,000 into 108. I hope the class understands. 2 lakh, which means 2,000 into 108. No interest is accrued, because till yesterday the interest has been paid to the purchaser, to the seller. So no problem at all. On 1st July 2018, another 1 lakh debentures were purchased come interest at rupees 112. Another 1 lakh debentures were purchased come interest at rupees 112. Leaving 8 lines, 9 lines. Okay. Working note for 1st July 2018. Working note for 1st July 2018. Okay, working note for 1st July 2018. What is the question saying? On 1st July, 1,000 debentures were purchased. 1 lakh means 1,000. Okay, purchase price, come interest is, my dear friends, 1,000 debentures into, what is the purchase price? 112. Okay, less, okay, less interest, my dear friends. 1 lakh is the face value, always on the face value, into 8% into 1st July is the transaction. April, May, June, 3 months interest has been accrued. 3 months interest has been accrued. So, okay, Therefore, cost will be 1,12,000 minus 2,000, 1,10,000. Okay, the transaction happens on 1/7. Bank, 1 lakh is the face value. Interest also we have computed 2,000, and cost also we know how much it is. 1,10,000. 1,10,000 is the cost. I hope the class is driving or traveling along with me. Okay.
Sir,
The,
but excuse me.
uh,
Sir, the question says 1 lakh debentures. Doesn't that mean the number of debentures?
no, 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 no. A Limited purchased another, not that apostrophe which you see here is rupees, my dear friend. Unfortunately, I did not have that rupee font. That's why here also you will find it is rupees. It is not 1 lakh. It is also face value of 2 lakh. Okay, so like that only. Please don't understand this as 1 lakh debentures, 80 debentures, 2 lakh debentures.
Okay, sir. Thank you.
The next transaction happens only on 1st October, but in between there will be an interest date. Okay, 39 bank. Okay, the interest will be on the face value of my debentures on that date into the rate of interest is 8% into for 6 months. Okay, that is my interest. That is my interest. The next transaction on the next day itself, on 1st October, 8,000 debentures are sold at rupees 108. So we can only take it as X interest. Anyhow, it is 1st October. Whether it is X interest or come interest doesn't make a difference. But suppose if it is 1st November or 1st December and they give it as just sold for 108, please understand we have to take it on the basis of X interest. If the transaction is silent, also X interest. If the transaction specifies, also X interest. Come interest means it should be clear. Okay, so 110 bank, I have sold 80,000, which means 800 debentures into 108, which means 800 debentures into 108. Let us compute the profit or loss. Whenever debentures are transferred, we will compute the profit. Working note for profit or loss for sale on 110. Sale value of 8,000 debentures, no 800, sorry. 86,400 less average cost. Less average cost. What is average cost? Total cost divided by total units into units sold. Average cost means total cost divided by total units into units sold. Okay, my dear friends, total cost 2,16,000 plus 1 lakh, sorry, 2,16,000 plus 1,10,000 divided by total units. Total units is 2,000 and 1,000, 3,000 units, that is 3,000 debentures into 800, which is sold. Total average cost means total cost divided by total units into units sold approximately I'm getting 86,933, resulting in a loss of 533. Okay, average cost basis means total cost divided by total units into units sold. Five thirty-three. I hope the class is following. A Limited received, on 1st December, C Limited gives the option of conversion of 8% debentures into equity shares. A Limited received 5,000 equity shares of rupees 10 each in conversion of 25% of their holding on that date. In conversion of 25% of their holding on that date. Listen please, 112. That is the date I get. I don't get bank. It is not bank. Shares in C Limited. Okay, I get shares in C Limited. For what face value I am getting? For 25% of the debentures held on that date. For 25% of the debentures held on that date, that is this plus this minus whatever I have sold, okay, into 25%. In other words, my dear friends, 3 lakh minus 80,000, 2,20,000, 2,20,000 into 25%. 2,20,000 into 25,000. What am I getting? I am getting 5,000 equity shares of rupees 10 each. I am getting 5,000 equity shares of rupees 10 each for converting my debentures. My debentures that are converted are 25% of the holding on that date. 25% of the holding on that date, and the interest will be 55 face value into rate into last I have paid it in September, October, November 2 by 12. Okay.
Sir,
Raja?
first working note இருக்குல்லைங்க சார், purchase price come interest 1,12,000.
ஆமாம்.
அது one time சொல்லுங்க சார்.
Raja, can I complete this and come back to that, Raja?
Okay, sir. Sure.
Surely I'll come back. Okay. So friends, on 112, I converted 25% of my holding. That is 25% of my holding goes off. And what do I get in return? I'm not getting back. I'm not selling it. I am just converting it. In return, I get equity shares of 5,000 equity shares at rupees 10 each. And the interest will be paid for 2 months by the company. Now, working note for transfer into or conversion into equity shares, profit or loss. Okay, conversion of 550. 55,000 means 550 debentures. Okay, what is the equity share value of them? What is the equity share value of them? 50,000 less average cost, nothing but total cost divided by total unit into units sold. Okay, right? What is the total cost? We have already worked out this. Okay, the total cost is 2,16,000 plus 1,11,000 divided by 3,000 unit into unit transferred is unit converted is 550 into unit converted is 550. Okay, therefore I make a further loss. Therefore, I make a further loss of on conversion. I make a further loss of 9767. On conversion, I make a further loss of 9767. So 112 P&L account. Okay, nothing but loss on conversion. Okay, nothing but loss on conversion, my dear friends. It is 9767. It is 9767. It is 9767. I hope the class is following. I hope the class is following. 9767 is the loss. Is the loss. Okay. Anywhere you are stuck, let me know. Meanwhile, I'll explain our friend. Okay, our friend has asked me how come I got this 1,10,000. Raja, okay, my come interest purchase price is 1,000 debentures. 1,000 எப்படி வந்தது 1 lakh divided by 100 face value makes it 1,000 debentures into 112. My come interest. Okay, this transaction happens on 1st July. So interest last of March, they have paid up to March, April, May, June, 3 months interest on the face value. 1 lakh into 8% into 3 by 12. So I am getting 1,10,000. Is that clear to you, Ramji?
Yes, sir. But yes, sir. I was confused that 1 lakh was face value, I think so.
Okay.
Now I got.
Yeah.
Sir,
Yeah.
while taking average cost, we should not include
Once more, can you please repeat your doubt? While taking average cost,
sales value minus 1.
your voice is not clear, friend.
So can we hear me now?
Can you text me? Can you text me, please? I'll immediately look into. Can you please text me? Can you kindly text me your doubt? Sir, while computing average cost, should we subtract the sale value? Her doubt is, while computing the average cost, should I subtract the sale value? My answer to her is, both are same. If you subtract also, you will get the same answer. If you don't subtract also, you will get the same answer. For our friend purposes, let us do it and see once. Okay, let us have this answer. Suppose if I take the average cost after reducing sale value. For my dear friends, please listen here. You need not take it down, but listen. Okay, what will happen? It will be 2,16,000 plus 1,11,000 minus 86,400 minus 533 divided by how many units? Okay, 3,000 minus 800. 3,000 minus 800. 3,000 I purchased. 3,000 I purchased. 800 I sold. Okay, divided by 2,200 into 550 units which are transferred. Okay, you will get the same answer, my dear friends. You will get the same answer. So I wish that you don't do it. You can directly take this. You will get the same answer. Average cost, even doing like this. If you want to do it, fine with me, but please be careful. You know, sometimes you will forget to take the profit, which will make your answer wrong. Okay, sometimes it will be in this question, it is loss, so you reduce. If it is profit, add that also and reduce. But the better method is not to consider that. Anyhow, I will have this also in the Excel sheet later when you are referring. Okay, you can have this, but generally, I don't think that is essential. I hope I clarified your doubt, friend. Okay, now going back to the question. Okay, the market price of debentures at the end of the year is 110 and 15 respectively. So now I'm going for the end of the year 3112 balance carried forward. Okay, before that, let me do the total. 1,65,000 in the face value column. Now I am going for working note for verification of cost or market price. Okay, number of debentures, we all know it is 1,65,000 divided by 100, 1,650 debentures. What is the cost of this? Very simple. Okay, your balancing figure is the cost of that. Your balancing figure is the cost of that. Okay, your balancing figure will give you the cost of that 179,300. Market price at rupees 110 will be 1650 into 110. Okay, 1650 into 110. The market price the question says is 110. Therefore, cost is less. Therefore, I can take the cost itself, that is lesser. that is lesser. So no worries, no worries. I can just put the balancing figure here also. Okay, 179,300. This into whatever is the rate of interest into 3 by 12 is what is accrued. And here 3112 profit and loss count. Just check whether you are understanding. I hope all of us are very clear about this. I hope all of us are very clear. Okay. Whenever there is a conversion, this question I specifically took up, just let know how the conversion works. Suppose if the question is not yet over, the question is not yet over, please understand, okay, we should also show the equity shares. We should also show the equity shares account. Okay, equity shares in C Limited. Okay, how much I got? Okay, by converting the debentures, I got so to 8% debentures. Okay, face value is also 50,000, cost is also 50,000, balance carried forward. Okay, face value is also 50,000, cost is also 50,000 because the market price is 15, whereas I'm doing it in the face value. So this is how you should have completed. So always, whenever there is a conversion question and they give you the equity shares, complete it with equity shares, please. Complete it with equity shares, miss not that. One last question in our fixed barrel, fixed return bearing before going to equity shares. Okay. Question number 4. On 1/4/2016, 2 lakh, that is rupees, that apostrophe on top is rupees. 9% government loan, 190 is the face value. 3 months interest as accrued on that date. On 31st May, the company purchased the same for 80,095 come interest. On 1st June, 60,094 ex interest. Interest were 30th June, 31st December, credited to the bank on the same day. On 30th November, 40,000 of the loan was sold, 97 come interest. 1st December, the company purchased 10,000 at face value itself. On 1st March, the company sold 10,000 at 95. The market price was 96 on the year end. On the year end, drop the account on FIFO should be followed, and the company valued the closing at cost or market price, whichever is less. Calculation to be made to the nearest rupee. Calculation to be made to the nearest rupee. Friends, you start calculating. I will join in between. You please start working out. Give me 2 minutes. I'll join in between. Please start doing.
1,65,500 and
1,65,500.
yeah, sir.
Sai Lakshmi, can you just check on the cost column again? Any date transaction you are not understanding, ask me. Any dates transaction. Opening balance is given in the question itself. Transaction on the first date, that is 31/5, is 80,000 purchase. 3,000 is the interest accrued, and it's a come interest transaction. So 80,000 into 95 minus 3,000 gives me 73,000. Gives me 73,000. On 1/6, they sold 60,000. That is 60,000 face value at 94 and made a loss of 600. Made a loss of 600. Interest accrued 2,250. Interest accrued 2,250. Then date of interest. Then on 30/11 again 40,000 is the sale value and it's a come interest transaction. So 40,000 into 97 or 400 into 97 minus 1,500. 400 into 97 minus 1,500. I get 37,300 with a loss of 700. With a loss of 700 again. And on 1/12, I purchased 10,000 at 10,000 ex interest 375. On 31/12, I got an interest of 8550. And on the last sale, there will be no profit, no loss. Check out on me for any working note.
Sir, I've wrongly posted the P&L balances, the 600 and 700 in this side, sir. So that was a...
Oh, you took it as profit.
Yes, sir.
Sir, can you please scroll down for working notes, sir?
Which working note do you want? I did not do for everything. That's why I'm asking.
I think so for the 1/6 transaction, sir. I have done wrong that one side only, sir.
56,400 is the sale value. Cost is here. Okay. Cost is 1,90,000 divided by 2,000 into 600 sold. You want to know how I got 56,400? That is directly, it's an ex interest transaction.
No, sir. I was.
Is that clear, friends? Shall I move on? Shall I move on? Okay, right.
Sir, before
So,
moving on to the next question, shall we have a breakfast break, sir?
no,
Sorry, sir, but I was so hungry,
no,
sir.
nothing to feel sorry. So we are progressing. This is how the answer for, and the answer is available. If you have a doubt, you can connect with me to clarify. Now I am going for fixed return bearing or variable. Okay, variable or flexible variable, or which is also known as flexible return uh, bearing investments, variable or flexible return bearing investments. I hope my Excel is visible and my audio voice is audible. Right.
Yes, sir.
Yeah, thank you. Yeah, so variable return bearing, and basically we are covering equity shares in this. More rarely preference shares can fall in this, but basically from an examination perspective, we are covering equity shares. What is this variable or flexible? Neither the return is certain nor the return is a fixed sum. Okay, neither the return is certain. You are not sure whether you will get the return. Even if the company makes profit, there is no surety that you should get a dividend. The company can decide to retain its earnings. Okay, the company can say that for future expansion they need money, so they are not distributing to the shareholders. That decision is purely the board members. So even if profit is earned, first the profit should be earned. Only if profit is earned. Profit earned also, dividend should be declared and then paid. So there is an issue. Okay, neither the return is fixed, neither the return is certain, nor the return is, you cannot say every year this is the sum, every 6 months this is the sum. There is no guarantee for the sum. So that is what is variable or flexible return bearing investments. That is what is variable or flexible return bearing investments. My dear friends, I'm going to slightly go in detail so that we are very clear about the theoretical aspect of it. Okay, right? The first thing is according to AS 13, only average cost basis should be followed for variable return bearing investments. Okay, only average cost basis should be followed, my dear friends. Okay, only average cost basis should be followed for variable return bearing investments. There is no concept of fixed, there is no concept of FIFO method here. Only go by average cost, okay, for variable return bearing investment. Okay, there are some reasons for that which we have seen in the classes like bonus shares, cost gets spread. Okay, all those things. Let's not go into the detail, but okay, right. So, because the accounting part of it needs a fast understanding by us, fast recollection of whatever we have studied. So, first on the accounting part, we will get a recollection. Okay, primary issue. How we will account it is, okay, cost will be price paid, which will include premium. Cost will be the price paid, my dear friends. For the primary issue, the cost will be the price paid, and the price paid will always include the premium also. Whatever may be the premium, that will also be included. So primary issue will be the price paid for the shares. The cost will be the price paid. What is primary issue? Issued by the company. Okay, so which will include the premium. Okay, secondary issue, that is I buy from a market. I buy the shares from a market. Okay. Cost will be the price paid plus all direct expenses incurred at the time of purchase. Okay. Secondary issue, the cost will be the price paid plus all direct expenses like stamp duty, brokerage as we saw. Okay. Whatever may be the direct expenses that will also be included, in the case of secondary issue. In the case of secondary issue, cost paid will be price paid plus all direct expenses incurred. Okay, that is for secondary issue. Bonus issue. Okay, we all know. This will be recorded only in the face value column and cost column will be nil, because we all know that the cost of bonus shares is nil. The cost of bonus shares we all know is nil. So bonus cost column will be empty. We will not record any value, but how many ever shares I got, the face value column will be recorded. In the face value column, it will be recorded. Please understand, bonus issue alone will be recorded only in the face value column. Same like our debentures, we will have face value column, nothing but the nominal value column, income column and the cost column. In the nominal value column, I will record it, but nothing in the interest column or nothing in the income column or nothing at all in the cost column, because cost of bonus is nil. Okay, rights shares. Right shares is nothing but like primary issue. Right shares is nothing but primary issue. Cost paid will be considered. Okay, then why are we having this as a separate thing? Because as a shareholder, the right of preemption. As a shareholder, my dear friends, as a shareholder, I have the right to subscribe. Okay, I have a right to subscribe to the share. So I will be given a proportion. I have two options. One, I can subscribe. Two, I can transfer my right, which is popularly known as renunciation of right. I can transfer my right, which is popularly known as renunciation of right. Let me be loud and clear. I am not transferring shares. I am only transferring the right to subscribe for shares. I am not transferring shares. I am only transferring the right to subscribe for shares. So if I renounce, whatever I get is considered as my income. Okay, rights shares. When rights shares are subscribed, it's like primary issue. The price paid, including the premium, my dear friend, will be treated as cost. Okay, when rights shares are subscribed, it's like primary issue. Whatever is the price paid, inclusive of premium, it will be treated as cost. Then rights are transferred. Okay, I am not transferring shares, my dear friends. I am transferring the right to subscribe for shares. I am only transferring the right to subscribe for shares. When rights are transferred, the consideration received will be treated as income. Consideration received, whatever consideration I receive for transferring the right will be treated as income, whatever consideration I receive. I hope the class is clear. Primary issue, secondary issue, bonus issue, rights issue. Okay, all these things will be recorded in the debit side. in the debit side. And when rights are renounced, we popularly call it as renunciation of right, which means when rights are transferred, whatever consideration I receive by bank in the income column, I will write. When shares are sold, sale value to be recorded in cost column will be actual consideration less expenses at the time of sales. Okay, when shares are sold, my dear friends, okay, when shares are purchased from the secondary market, brokerage and other expenses are added. When shares are sold, transferred, brokerage and other expenses are reduced. The expenses at the time of sales will be reduced when shares are sold. Okay, the profit or loss on sale needs to be computed, okay, needs to be computed at average cost basis. What basis we are following? Average cost basis. For debentures, for fixed return bearing investments, FIFO, unless it is specifically said average cost. Here, if nothing is said or said, average cost basis is the method to be followed. Concept of pre-acquisition and post-acquisition dividend. Concept of pre-acquisition and post-acquisition dividend. What is meant by pre-acquisition dividend? If dividend is declared for a period before purchasing shares, if dividend is declared for a period before purchasing shares, then it is pre-acquisition dividend. Then it is pre-acquisition dividend. Then it is pre-acquisition dividend, which should be recorded in cost column on the credit side. If dividend is declared for a period before purchasing the shares, you will receive the dividend only after purchasing the shares. That is for sure. But the dividend you are receiving in hand is not for the period after purchase of shares. It is for a period ending before purchase of shares. Then I will call it as pre-acquisition dividend, and I will not record it in the income column. It will be recorded in the cost column on the credit side by bank. On the credit side, this will be recorded. Okay. If dividend is declared for a period, okay, if dividend is declared for a period after acquiring the shares, then it's post-acquisition dividend. Then it is post-acquisition dividend, which should be treated as income, which should be recorded, which will be recorded as income, which will be recorded as income. Pre-acquisition dividend will be treated as cost. Post-acquisition dividend will be treated as income. Pre-acquisition dividend will be recorded on the credit side cost column. Post-acquisition dividend will be recorded on the credit side income column. Suppose 31/3/2019, the year ends for the company, not for the investor, for the investing company. I purchased the shares only on 1/6/2019. The company paying dividend in the month of August for the year ended 31/3/2019. The company is paying dividend for the year ended 31/3/2019. I will receive the dividend because on August I am a shareholder, but this dividend is for the period before me purchasing the shares, because I purchased only on June 19, but for the dividend is for the year ended March 19. So this will be known as pre-acquisition dividend. Pre-acquisition dividend. Suppose I had purchased the shares on 1/1 itself. Now it is post-acquisition. So in short, in the given example, if I purchase the shares before 31/3/2019, if I purchase the shares before 31/3/2019, my dear friends, please understand, if I purchase the shares before 31/3/2019 in the given example, then whatever dividend I get after 31/3/2019 for the year ended 31/3/2019 is considered as post-acquisition dividend. But if I have purchased the share only after 31/3/2019, but dividend is paid for the period 31/3/2019, it is pre-acquisition dividend will go only to the cost. Will go only to the cost. Yes. Okay. Some end notes which are essential again. Unless otherwise stated, face value of shares is ₹10. If they say 100, take 100. In one rare question, I saw it as 25 face value, rare question. But generally, unless otherwise stated, face value is ₹10. Dividend will be computed on face value. Like debentures, here also, dividend will be computed only on the face value. Dividend will be computed only on the face value. Okay, my dear friends, this is an important note. Okay, this is an important note. Okay, right shares and bonus shares will not be eligible for dividend if the dividend is for the period before their issue. Right shares and bonus shares will not be. So let me take this example. 31/3/2019 year ended. 1/6/2019 day I purchased the share. 1/7/2019 the company gives bonus and rights. Now in August they are declaring dividend. In August, they are declaring dividend for the year ended 31/3/2019. At that time, I will not compute. I will not compute that dividend for rights and bonus shares, because rights and bonus shares became the property only in 1920. But this dividend is for the year ended 1890, 31/3/2019. So I will not be computing. So rights and bonus shares will not be eligible for dividend if the dividend is for the period before their issue. If the dividend is for the period before their issue. Interim dividend is paid between 2 financial years. Okay, interim dividend is something which is paid in the between 2 financial years. You would have studied in your company law also. Interim dividend is paid between 2 financial years. For interim dividend, rights and bonus will qualify. Okay, for interim dividend, my dear friends, rights and bonus will qualify. Please read through the entire theory once. If you have a theoretical doubt, ask me. So be sure about these concepts. Okay, looking at the theory, it will be lengthy. While doing the solution, it will become very simple. Only place you have to be careful is pre-acquisition, post-acquisition. Otherwise, everything will fall in place. I am looking into question number 5. I am looking into question number 5. Mr. Vijay entered into the following transaction for purchase and sale of equity shares of JP Power Limited. And they have the paid up value as rupees 10. Number on 1/1/2016, 620 per share, 925, 1023. 2,500 bonus, 1,500 sale, 1,000 sale. Okay, additional information. On 15/9/2016, dividend at rupees 3 per share was received for the year ended 31/3/2016. Okay, my entire purchase, okay, 1/1/2016. It is post acquisition. The date of dividend is 31/3 for the year ended 31/3/2016. Before that, I have purchased. Before that, I have purchased. So the dividend becomes after the acquisition only 15/3 post acquisition. Whereas for these 25 for bonus shares, dividend will not be given. Whereas 25, I purchased 1,000 shares. For this, whatever dividend I get is known as pre-acquisition dividend. Is known as pre-acquisition because my date of purchase is only 20th May, whereas I am getting the dividend for the year ended 31/3. So the dividend is for the period before acquiring the shares. So it becomes pre-acquisition. Pre-acquisition. On 12/11/2016, company made a rights issue of in the ratio of 1 share for every 5 shares held at rupees 20 per share. He subscribed to 60% of the shares and renounced the balance at a premium of rupees 3 per share. Shares are to be valued at average cost. We all know that, and you are required to prepare investment account for the year ended 31/3/2016 and 31/3/2017. For the year ended 31/3/2016-17. So two things to remember. 1, 2, then 25 there is a transaction. Okay, the rights, okay, 15/9 there is a transaction, 12/11 there is a transaction. Okay, we will remember all these things. Okay, remember all these things, and they want it for 2 years, which is making it very nice to prepare. At the same time, extremely good question to understand all the concept at one go. Okay, I start the entire transaction on 1/1/2016. I started on 1/1/2016. Balance brought down. Okay, in the face value column, 600 shares means 600 into 10, that is 10 rupees the face value, and in the cost column, 20 rupees is the purchase price. Okay, in the cost column, 20 rupees is the purchase price, 12,000. Then again on 15/3, then again on 15/3, I purchase another 900 shares for 25. I purchase another 900 shares for 25. So that makes it 22,500. Now, my dear friends, okay. So 1 year is over. On 31/3, balance carried forward. Okay, on 31/3, balance carried forward. Okay, okay, 15,000 shares, 34,500. I'm not doing the totaling. I know you can do that. Okay, to be on the safer side, so that when you refer, you are clear. Okay, so in that next year, that is 2016-17, I have a, okay, 1/4. Okay, the balance brought down as 15,000 and 34,500. 15,000 and 34,500 as balance brought down on 1/4. Now it is all the more clear what is going to be pre-acquisition and post-acquisition dividend. It is all the more clear. Now progressing. On 25/2016, 1,000 shares were purchased at rupees 23 per share. On 25, bank 1,000 shares are purchased for rupees 23 per share. 1,000 shares are purchased for rupees 23 per share. Okay, on 25/7/2016, I think a dividend is only after that. Yeah, on 25/7/2016, bonus shares 2,500 are received. 25/7 bonus only recorded in the nominal value, that is face value column, it will not hit the cost column at all. It will not hit the cost column at all. Bonus shares, my dear friends, bonus shares will not affect my cost column. Only my face value column, it will have an impact. So bonus 25,000 only in the face value, nothing in the cost column. Nothing in the cost column. Okay. Now comes the concept of dividend. On 15/9, dividend of rupees 3 is declared for the year ended 31/3/2016. So this bonus shares will not be eligible for dividend because it is issued after 31/3/2016. Okay, so it is not eligible. Only these two are eligible for dividend. That takes me to a concept. That takes me to a concept. Please understand. For this 15,000 which is there in the opening balance, the dividend I received is my income because it is purchased before 31/3/2016. Post acquisition dividend. After acquiring the shares only, that is the period ends and dividend is paid. Pre-acquisition dividend. Dividend is paid for a period before acquiring the shares. I purchased only on 25/2016. Dividend is paid for the year ended 31/3/2016. So that is pre-acquisition dividend. Whereas for that 15,000 face value, it is post-acquisition. I hope the class is clear. Okay, 15/9 bank. Okay, what goes to the income column is, okay, divided by 10 into 3. That is 1,500 shares. 1,500 shares into 3 rupees per share. Here, 1,000 shares into 3 rupees. 3,000. Is this clear? Enna Ramji clear-ஆ இருக்கா இது?
Yes, sir.
What Sai Lakshmi, Anjani?
Yes, sir, it's clear, sir.
Raja, is anybody not understanding? Okay, please understand post-acquisition, pre-acquisition. Yeah, post-acquisition, pre-acquisition, please understand. Okay, after the, if it is there in the opening balance, maybe blind. If it is there in the opening balance, obviously it will be post-acquisition. If it is purchased during the year and for that shares, you are getting the dividend, not interim dividend. Proposed dividend of the last year, then it is, okay, pre-acquisition. It should go to the cost. Good. On 12/11/2016, the company made a rights issue of 1 share for every 5 shares held. Okay, Vijay is holding, my dear friends, if you look at this, he is holding 50,000 nominal value, which means 5,000. Which means 5,000. I'll do the quick working note. Okay, for rights shares. Okay, total shares held on, what is the date? 12/11. Okay, is nothing but divided by 10, 5,000. Eligibility, the question says, he is a company rights issue in the ratio of 1 share for every 5 shares. So divided by 5 into 1, he is eligible for 5,000. Subscribed, he has subscribed 60%. Okay, you can see he subscribed for 60% and renounced remaining 400 rights. This shares illa. he has, because wrongly if you put it here at the face value column as 400, your answer will go wrong. I have not sold shares. I have only sold the right to subscribe for shares. Okay. Okay. I think that is clear. So on 12/11, bank, I took up 600 shares. Okay, into 10 rupees the face value, and 600 into 20 rupees is my issue price. 20 rupees issue is my issue price. On the flip side, on the same date, bank, okay, a renunciation of rights, bank, nothing but renunciation of rights. I sold in the income column. I sold away 400 rights. I did not sell shares, only rights, 1200. Next transaction is on 20/12/2016, 1500 shares sold. Okay, 2012, okay, bank, how many shares sold? 1500 into 10, and the sale price is 22. 1500 into 22. Whenever there is a sale happens, we need to identify profit or loss on sale on 20th December. Profit or loss on sales on 20th December. Sale value of 1500 shares. We all know sale value is 33,000. Less average cost. What is average cost? Total cost divided by total unit into unit transferred or unit sold. Okay, friends, I am taking you to a long path. Now, please take your time to understand, then write down. Okay, if you remember that, fine. Okay, total cost, okay, my dear friends, 34,500 plus 23,000 plus 12,000 minus 3,000. Total cost, there is a reduction. Pre-acquisition dividend, there is a reduction. So total cost 34,500 plus 23,000 plus 12,000 minus 3,000 divided by total number of units on the debit side, 15 plus 10 plus 25 plus 6, 56,000, which means 5,600 shares. I am repeating. Debit side line, the C column pathina 15 plus 15,000 plus 10,000 plus 25,000 plus 6,000, 56,000, which means 5,600 shares into number of shares sold 1,500. Okay, okay, repeating the formula, total cost divided by total number of units into numbers transferred. When I do the total cost, I should be cautious to ensure that to deduct the pre-acquisition dividend, which will be appearing on my debit side. So 34,500 plus 23,000 plus 12,000 minus 3,000. Okay, you will get 17,813, leaving you with a profit of 15,187. 15,187. 2012 P&L account. Okay, 15,187. 15,187. I hope the class is following. I'm doing the next transaction. You try it yourself. You try it yourself. Raj, I'm listening. Raja, I'm listening. You can go ahead.
50 to 180 is 4823, like, sir. Total unit. Can you please explain
Your
that, sir?
voice is not clear. Can you again repeat? Very slowly repeat.
Sir, average cost on the value found out பண்ணது மட்டும் கொஞ்சம் சொல்லுங்க சார்.
Average cost na, what is average cost is total cost that is there in the debit side.
17813.
Huh? Yeah, I'm explaining you. Average cost means total cost on the debit side minus this 3000. Okay. 34,500 plus 23,000 plus 12,000 minus 3,000 divided by total number of shares 5,600. How the total is 56,000 divided by 10, 5,600 into number of shares sold. Am I clear to you, Ramji? Some network error. Profit or loss on sale on 1st February. Okay. Sale value of 1,000 shares. Sale value of 1,000 shares, my dear friends, is 24,000 less average cost. Ramji, if you are there, the same I'm going to do again. Okay. Total cost divided by total unit into units sold. Okay, how do I find it? Okay, total cost is 34,500 plus 23,000 plus 12,000 minus 3,000 divided by total number of unit is 5,600 into
Yes, sir. Thank you.
units sold is 1,000. Okay, 11,875, leaving me with a profit of 12,125.
So why are we not supposed to add the P&L amount of 15,187 here?
Yeah, I can do that way also and prove you. 1 minute, I will. Okay, if you want in that way, for example, okay, the other way of doing my average cost, okay, is okay for your. This is not for your writing. Just I'm giving you the idea. Okay, so what we do, we add 34,500 plus 23,000 plus 12,000 plus 15,187 minus 3,000 minus 33,000 divided by எவ்வளோ shares 5,600 minus 1,500. 5,600 I purchased, 1,500 I sold, divided by 4,100 into 1,000. Okay, the same answer only you will get. Okay, it is, if you look at it, the same answer only you will get always. So I would always tell you not to include that sale and profit. If you include both. Sale and profit you include, reduce divided by number of units, that sold units should be reduced. So better not to complicate is my personal opinion. Okay, friends. 1, 2. P&L account, $12,125. $31,300. Balance carried forward.
Sir,
Go ahead with your question.
so the rights shares are renounced at premium of rupees 3. So is it 3 or 13?
Just 3.
Sir?
There is nothing called 10 here. Company is not selling, only you are selling. That word premium should not have been used, I agree, but it is only 3 rupees.
Okay, sir.
I hope you are getting this profit. I hope you are getting this profit, my dear friends. Okay, equity shares are mostly asked, and it will be very simple. The only concentration is pre-acquisition dividend and average cost. Please remember this. You will be able to do it. This question which we worked is a wonderful question. If you can work it out once or twice, you will get more confidence. Question number 6. On 1/1/2016, Mishra Limited had 10,000 equity shares of 10 each in Ram Limited, purchased for 1,25,000. Do not make apportionment. Okay. On 15/5/2016, Ram Limited made a bonus issue of 1 fully paid shares for 2 shares held. In addition, on the same date, rights were issued for 3 shares for 5 shares held on that date at a premium of rupees 3. 7 is to be paid in application and the balance in a 1 month. These shares are not to rank for dividend ending 30th June 2016. 2,000 right shares were taken up by Mishra and balance were sold at rupees 2 each. On 15/10/2016, the company declared a dividend of 20% for the year ending 30th June 2016. Prepare investment account in the books of Mishra. Read through. No pre-acquisition, no sale. It's a very simple, straightforward question. On 1/1/2016, Mishra had 10,000 equity shares. So he has already purchased for 10 each, 125. Okay. So it is 1/1/2016, or I can even put 2016. Okay. Under that 1/1 balance brought down. Okay. 10,000 shares into 10 rupees per share, 1 lakh, whereas cost is 1,25,000. 1 lakh, whereas cost is 1,25,000. On 15/5/2016, Ram Limited made a bonus issue of 1 share for every 2 shares held. On 15/5, okay, bonus, I get 1 share for every 2 shares held. Only in the face value column, nothing will appear in the cost column. In addition, on the same date, rights shares were 3 shares for 5 shares held. For computing rights shares, will I take bonus shares? For computing rights shares, will I take bonus shares? Can someone answer that?
No, sir.
No. Okay, that is
Sir,
the
no, sir.
answer. Okay, I will tell you the sanctity behind this. If bonus is first, then rights comes. I will include bonus shares to compute the eligibility. If bonus rights are on the same date, then I will not take bonus shares for computing the eligibility of rights. Repeating. For eligibility of rights, should I take bonus shares or not? On a safer side, shall I write it as an end note? If bonus shares are issued first and then rights are proposed, then for computing the eligibility of rights, we will also include bonus shares. Okay, if bonus is issued first, last question. If you look at it, bonus is on 25/7, rights is on 12/11. So we took the bonus shares also to compute the eligibility. Okay, if bonus and rights are on the same date, then for computing rights, we will not include bonus. Then for computing rights eligibility, we will not include bonus. Please remember that. So here also, I am not going to include the bonus because it is on the same date. Okay. On the same day, rights 3 for every 5 shares at a premium of 3. So the issue price is 13 rupees, 7 on application, 6 after 1 month. These shares are not to rank for dividend. 2,000 rights were taken up, balance being sold. Okay, how much he is eligible to? I am holding 10,000 shares. Don't take bonus. I am holding 10,000. 3:5, 3 shares for every 5 shares held. So eligibility is 6,000. Okay. Total shares 10,000 only. Bonus shares I will not take. Okay. Issue eligible. Okay. 3:5. 3 shares for every 5 shares divided by 5 into 3. Subscribed. How many shares are subscribed by him? 2,000. Okay. Rights that sold, not shares. Rights sold is 4,000. So first let us record the income. Let us record the income 25,500. Bank, he has sold, okay, 4,000 rights and he is getting rupees 2 per right. That is my income. Okay, that is my income. Now coming to right subscription, please understand how I am recording. Okay, 50, okay, balance, okay, on 15/5 bank, I am taking up how many rights? Subscribing 2000 into 10. But here I am paying only 2000 into 7. 1 month later, 15/6, again bank. At that time, don't again enter in the face value column. 2000 into 6. Okay. Instead of writing it once, you are writing it on application on allotment. But 13 rupees into 2000 shares, 26,000. That is what I have recorded. That is what I have recorded. Okay, 2000 right shares were taken up and the balance was shown. On 15/10, the company declared a dividend of 20%. Already they have said rights and bonus will not qualify. So on 15/10, okay, bank nothing but the dividend. Okay, rights and bonus will not. This into, that is face value of opening balance of shares into 20%. 20,000. That's the question.
Sir, rights and bonus were issued before the year ending now.
Yes, but the question specifically states, if they are not said, I will not, I would have included. The question specifically states, look at the question. These are not to rank the question, so only. The last question, which is bonus which is equity come debentures. One question. Question number 7. Following transactions of Nisha took place during the financial year 17/18. 1st April 2017, purchased 9,000 8% bonds of 100 each at 80.5 come interest. The interest is payable on November and May. 1st May, received that interest. 10th July, purchased 12,000 shares of 10 each in Moon Limited for 44 through a broker who charged 2%. 1st October, sold 2,250 8% bonds at 81x interest. Okay, 1st November, received bond interest. 15th January, Moon Limited made a rights issue of 1 share for every 4 shares held at rupees 5 per share. Nisha exercised the option of 40% and sold the balance at rupees 2.25. 15th March received 18% interim dividend, which means even the rights will qualify. Interim dividend on equity shares of Moon Limited. Prepare separately investment account of 8% bonds and equity shares of Moon Limited in the books of Nisha for the year ended 31st March 2018. Assume average cost is followed. Read through. Okay, right. Okay, right. We will first do, it's like 2 questions, that's all. We will first do 8% bonds account. I'm doing, I without looking at the monitor, try to do it. Later we will verify the answer. That will be better. Even you can mute your audio and do mute the system audio itself so that the sound doesn't disturb you. I'm also not going to tell and do. I'm just going to do. We will verify. Wherever you are stuck, I'll help you.
Sir,
Go ahead.
in 8% bonds account on 1st October, the interest is 7,500, sir.
I made a mistake.
It's for 5 months, sir.
1st October means I last paid it on May, right?
1st
June?
May, sir.
Huh?
1st May, sir. So
First
May.
May.
So May, June, July, August, September, 5 months. Stands corrected, my dear friends. Here also did I do that mistake? November, December, Jan, Feb, March. Here also I should have done 5 months. Did I do the opening balance correctly?
Yes, sir.
Yes, sir.
Oh. Friends, 15th January transaction of Moon Limited. Moon Limited made a rights issue of 1 share for every 4 shares held at rupees 15 per share. I think it should be more than that, but at least we'll keep it at rupees 15, not 5, rupees 15 per share, please. At rupees 15 per share, not 5, my dear friends. At rupees 15 per share, make the due changes. Nisha, exercise the option of 40%. Make the issue price as rupees 15 per share.
Sir, my
Raja.
renunciation is different from your renunciation, sir.
Once more.
My renunciation part is different, I think so, sir. Can I please explain the renunciation part once again, sir?
In this
Renou-
question,
Yeah, sir. Yeah, sir, in this question, sir.
Okay, the number of shares is 12,000, Raja. He initially purchased 12,000 equity shares. His Moon Limited made a right issue for 1 share for every 4 shares held. So he will be eligible to a right of 3,000. Nisha exercised 40% of her entitlement. She exercised 3,000 into 40%, 1,200 shares she subscribed and renounced the rights of 1,800 shares. Am I clear, Raja?
Yes. Yes. I know about it.
Sir,
Go ahead.
can you show the bonds account, sir?
Yes, sure.
Sir,
Raja?
sir, equity shares account knowledge project. Final. So still I made a mistake on renunciation part, sir.
You are not clear
4,000
about renunciation?
Yeah, sir.
Raja, I have 12,000 shares. Okay? Nothing but 1,20,000 divided by 10. 12,000 shares I have. Issue is 1:4. One share for every 4 shares. So 12,000 divided by 4 into 1, I am eligible for to subscribe for 3,000 shares. I am eligible to subscribe for 3,000 shares. I only subscribe for 40%. That is 1,200. what I renounce is whatever is the balance. I am eligible for 3,000. I subscribe 1,200. I renounce 1,800.
Yes, sir. Thank you, sir.
Sir, that 5 per share is an increment of 5 per share, or is it 15 rupees altogether, sir?
Altogether, 5 rupees
Uh,
premium.
okay, sir.
So typographical. To question number 8, my dear friends. Question number 8 in page number 7. It's a more theoretical question. I have told you that this standard covers both long-term investment and current investment, right? I have told you that this chapter covers both long-term investment and current investment. This question is more from the perspective of conversion of an investment into current to long-term, long-term to current. Okay, before we progress with the question, let me give you the theoretical perspective of it. Okay, according to AS 13, where investments are reclassified. Reclassified means I convert the short term into a long term or long term into a short term. Okay, the basis of recording is as follows, where long-term investment is converted into current investment. That is, my dear friends, for ease of understandability, I can even say where non-current investments are converted into current investments, where long-term investments are converted into current investment. The transfer should be made at my dear friends, cost or market value, cost or carrying value, whichever is less. Either the original cost or the carrying value, whichever is less. Either the original cost or the carrying value, whichever is less. Okay, where current and long-term investments are converted into current investments, the transfer should be made at cost or carrying value. Carrying value is the book value. You can understand the carrying value as the book value, whichever is less. Vice versa. Write down where current investment are converted into long-term investment, which is nothing but non-current investment, then the transfer has to be recorded at cost or fair market value, whichever is less. Okay. where current investments or then the transfer has to be recorded at, my dear friends, cost or fair value, whichever is less, fair market value, that's what it means. At cost or fair market value, whichever is less. This is the principle. Whenever you make a conversion, this is the principle. And please remember, a long-term investment will always be, if you are buying it, will always be stated at cost. Only a permanent diminution will reduce its value. A long-term investment will always be stated at cost. Only a permanent diminution will reduce its cost. Only a permanent diminution will reduce its cost. Keeping these things into our mind, we will approach it. We will approach the eighth question. A. A portion of long-term investment purchased are to be classified as current investment. The original cost of these investments was 14 lakhs, but has been written down by rupees 12 lakh, 2 lakhs, which makes it 12 lakhs, my dear friends. Which makes it 12 lakhs. Please understand, this is now 12 lakhs. The market value of these investments is rupees 11 lakhs. Now come back to the theory. Let's read the theory and see where a long-term investment is converted into current investment. The transfer should be made at cost or carrying value of the asset, or the carrying value of the asset, whichever carrying value means book value of the asset. Okay, either at cost or at book value of the asset, whichever is lesser. It should be at cost or book value of the asset, whichever is lesser. So going that by that principle, okay, and I'm answering it here itself, though this is a practical, okay, but since it covers the question, I'm answering it here itself, my dear friends. One, okay, right? The carrying amount is rupees, we all know 12 lakhs, okay, 12 lakhs, my dear friends. The cost is rupees 14 lakhs. Hence, it needs to be transferred at rupees 12 lakh, because whichever is less, it needs to be transferred. Sir, market value is 11 lakhs. Market value is a concept only on the year end date, not in the middle date. Never worry about it, because the whole question talks about on 15th June 2018. On 15th June 2018, Y Limited wants to reclassify its investment, decide and state how the transfer should be. So it is not a year-end date. Okay, so the next year-end date is only 31st March 2019. On that day, it will remain as a current investment. At that time, let us see whether cost or market price, whichever is less. Now, as of now, so the principle is, if a long-term investment is converted into short-term investment or current investments, actual cost, which is 14 lakhs, but it has been reduced, or carrying value, which is the book value of the asset, whichever is less. Shall we read the second? Another portion of long-term asset purchased on 15th January are to be reclassified as current investment. The original cost of these was 7 lakhs and written down to 5 lakhs. The fair market value is 4,50,000. The fair market value is 4,50,000. That is not at all our criteria. That is not at all our criteria. So for the second, it's so the carrying amount or cost, whichever is less. We all know carrying amount is 5 lakhs, cost is 7 lakhs. Okay, therefore, carrying amount of rupees 5 lakhs is to be recorded. okay, is to be recorded at the time of conversion, my dear friends. The portion of current investment purchased for rupees 7 lakhs ought to be treated as long-term investment as the company has decided to retain them so. The market value of these investments are rupees 6 lakhs and the fair value is rupees 8 lakhs. The market value and the fair value. So my dear friends, okay, my dear friends, okay, the fair value on the date of conversion. Never worry about market value on the year end. We are only worried about fair value on the date of conversion. So when I look into the second part of our standard, which states where current investments are to be converted into long-term non-current investment, then the transfer has to be recorded either at cost or fair market value, whichever is less. Cost is rupees 7 lakhs. Cost is rupees, a portion of current investment purchased for rupees 7 lakhs or to be reclassified as long-term investment to, okay, the cost is 7 lakh, fair market value on the date of conversion. Never worry about year-end value. Our year-end value is going to be 31st May, March 2019, not the last year. Okay, so it should be carried at or recorded at 7 lakhs. Okay, third. Okay, in case of conversion of current into non-current, then cost or FMB on the date of conversion, whichever is less. So going by that principle, in the given case, the cost is rupees 7 lakhs. FMB on date of conversion is rupees 8.50 lakhs. Hence, it should be recorded at cost. I hope the class is clear. It should be recorded at cost. The fourth one. Another portion of the investment which was purchased for rupees 4 lakhs is to be reclassified. I don't worry about 31st March. I am only worrying about 15th June, on which date the fair market value is 3,80,000. Okay, the same first line you should write. The same first line you should write and then start the answer. In the given case, cost is rupees 4 lakhs. Fair market value on the date of conversion is rupees 3,80,000. Hence, it should be recorded at rupees 3,80,000. Hence, it should be recorded at 3,80,000. Hence, it should be recorded at 3,80,000. I hope it is clear, my dear friends. Okay, conversion of current investment into non-current investment, cost or book value, whichever is less. Conversion of for conversion of non-current into current, cost or book value, whichever is less. Conversion of current into non-current, cost or fair market value on the date of conversion, whichever is less. I hope this is clear, friends. I hope this is clear. We will complete with question number 9, this investment chapter. Okay. Question number 9, the recent RTP question. Meera carried out the following transaction in the shares of Kumar Limited. On 1st April 2019, 40,000 equity shares are purchased for of rupees 1 each. Face value is 1 here. Face value is rupees 1. Please understand. I told you, unless otherwise stated, it is 10. When it is stated as 1, take it up. Paid up for rupees 16. 15th May, Mira sold for 8,000 shares for 15,200. At a meeting on 15th June 2019, company decided to make a bonus issue of 1 share for every 4 shares held on 1st June 2019 to give its members the right to apply for 1 share for every 5 shares held on 1st June 2000. Both are on the same date. Rights does not succeed the bonus. Okay, at a price of 1.50, of which 75 is paid on 15th July, balance on 15th. The shares were not to rank for dividend toss on 31st December 2019. Mira received her bonus shares and took up 4,000 right shares, paying the sum thereon on the due dates. The rights of the remaining shares are sold for 40 per right per share. The proceeds were received. On 15th March, she received a dividend of 15% for the year ended 31st December 2019. On 30th March, she received 28,000 from sale of 20,000 shares. You are required to record the above transactions in the books, transferring any profit and loss to P&L account. Apply average cost basis, expenses and taxes to be ignored. Okay, the first thing we understand it, bonus and rights are on the same date. So for computing the eligibility of rights, I will not include bonus. Suppose bonus is first, then followed by rights, then I will include the bonus as we did the first question. Here I will not include. Read through. (1920). Friends, I start the solution. Okay, it says on 1st April only shares are purchased, okay, for a paid up value of 140,000 shares. 1 rupee is the paid up value. Okay, 14 bank 40,000 and 60,000. On 15th May, Mira sold 8,000 shares for 15,200. Okay, on 15/5, okay, bank 8,000 shares for 8,000 shares, 1 rupee share, 15,200. 15,200. Okay, working note for profit or loss on sale. Working note for profit or loss on sale. Okay, working note on profit or loss on sale. Okay, 15.5. Okay, sale of 8,000 shares. My dear friends, 15,200 less cost. Okay, okay, because there is only one purchase, directly we can go divided by 4,000, 40,000 into 8,000. 3,200 is the profit. 3,200 is the profit. 15.5 profit and loss account. 3,200. 3,200. At a meeting, it was decided to make a bonus issue of one fully paid up share for every 4 shares held. Okay, so on what date the bonus is given? Mira received her bonus shares. Okay, okay, let's take it as 1st June itself. Don't worry about the date, only for fixed interest bearing, the dates are important. Here it's important but not very imperative. So on this date, how many shares I have? I have 32,000 shares, and the bonus issue is 1 share for every 4 shares. So I will get 8,000 shares. 1 rupee is the face value. So 8,000, nothing in the cost column. Nothing goes to the cost column. In the face value column, 8,000. In the face value column, 8,000, my dear friends. Then give its members the right to apply for 1 share for every 5 shares held to be paid at 1.50, 75. Mira received bonus, took up 4,000 rights, sold the balance right at 40 pies. Okay, let's calculate. Okay, working note for rights eligibility. Number of shares held. Okay, as I told you, my dear friends, as I told you, okay, as I told you, my dear friends, okay, in while computing the number of shares to be held, my dear friends, as I told you, bonus should not be considered. So number of shares held, 40,000 minus 8,000. Okay, rights eligibility, the question says, okay, 1 share for every 5 share, 1:5, 1 share for every 5 shares held, 6,400. Rights subscribed is 4,000. Rights transferred is, my dear friends, 2,400. Right subscribed is 4,000. Transferred is 2,400. So on 15/7, okay, on 15/7 bank account, okay, 1 rupee per share, so 4,000. I pay 75 paisa on 15/7. Okay, 75 paise. Balance on 15/9. At that time, don't do the mistake of doing it again in the face value column. It is only on the cost column because it is paid in 2 installments for the same shares. For the same shares, it is paid into installment. In examination tension also, don't do it in the face value column. Be little cautious. Okay. Now, on 15.9, bank, these right shares are transferred for 40 pies. 960. So adjustment 1, 2, 2A is over 2B. Okay. On 15th March 2020, she received 15% dividend. Okay, so the question itself is clear. Rights and bonus will not be enjoying the dividend. You can see it, okay, in point number 2 under that the shares issued under 1 and 2, that is bonus and are not to rank for dividend. If the statement is not there, I would have taken. Okay, but since the statement is there, okay, it is 15th March 15.3 bank. Okay, my dear friends, it will be on the face value. It will be on the face value into 15%. I have 32,000 and 15%. On 30th March, she received 20. The question is it a post-acquisition? Yes, because the year ended is 31st December 2019, but I have purchased it in April 19 itself. Okay, only if I have purchased it after 31st December 2019. Suppose I have purchased it in January 2020. In March 2020, I will get the dividend, but that will be pre-acquisition dividend. But here, the shares are very much purchased before 31st December 2019. So it's an income only, not a cost. On 30th March, 20,000 shares are sold for 20,000 shares are sold for 28,000. 28,000. For profit or loss on 30th March. Sale value of 20,000 shares. Sale value of 20,000 shares is 28,000 less average cost. Okay, total cost divided by total units into units sold. Let's do the method in which you all want to do once. Okay. Directly in the method which you have always asked me, can we do like this? Divided by number of shares, my dear friends, 48, 52 minus 8. Okay, minus 8, 44,000. Okay, because 1 rupee per share into 20,000. Okay, repeating 60,000 plus 3,200 plus 6,000 minus 15,200 minus divided by number of shares in hand, not the total number of in hand is 40 plus 8 plus 4 minus 8. Okay, into number of shares sold 20,000. So you will hit at 24,545. Profit is 3455. 3455. Profit is, my dear friends, 3455. Profit is 3455. Now, you will wonder why this question alone. Why this question alone? I did not do the total cost divided by total unit. I'll explain you the logic. The problem is I have an in-between sale. After that, bonus shares get issued. After that, bonus shares gets issued. In that case, the better method, nothing wrong in going by our own method, but there will be a small difference of maximum 100 rupees, that's all. But the better method is, if there is an in-between sale, after that the bonus are getting issued, please try to follow this method of finding out the cost. Okay, nothing wrong in going by our method. Maybe your 100 rupees, that's all the difference might be, max. Okay, but the problem is this bonus we computed not for 40,000 shares, only for 32,000 shares. That's why that small difference will come. Had it been computed for 40,000 shares, I would have said that our method would have held good. But here, since there are two sales and after a sale bonus, there is nothing wrong in two sales. After a sale, bonus is getting issued, because of which the component of bonus shares changes. That's why I am saying in this question, I went by that method. Right, friends? Okay. Is the market value given anywhere? No. Am I clear to you? Okay. So my dear friends, this is the maximum in investment account. This along with your assignment question, if you work out, be sure you are through with investment account and we can tap that required mark. Okay. This is investment account for you. And we have also covered a question on AS13 on the transition. Okay, do the assignments. I'll post the solution of assignment. Meet you in the next class for revision of insurance claims. All the very best.